Welcome! Today, we're diving into how you can start investing even if you don't have a lot of money. Many people believe you need thousands of dollars to begin, but that's simply not true. With the right approach, anyone can start building wealth, no matter their starting point. In this video, we'll walk you through practical steps, tips, and strategies to help you take your first steps into the world of investing. Whether you're a student, a young professional, or just looking to grow your savings, these methods are designed for beginners. Let's break down the barriers and show you how easy it can be to start investing with just a little money. Starting early is one of the most powerful advantages you can give yourself as an investor. Even small amounts can grow significantly over time, thanks to the magic of compound interest. The earlier you begin, the more time your money has to work for you. This means you don't need to wait until you have a large sum saved up. By starting now, you're setting yourself up for a brighter financial future. Remember, it's not about timing the market, but about time in the market. Let's see how you can make your money work for you, even if you're starting small. Compound interest is often called the eighth wonder of the world. It's the process where your investment earns interest, and then that interest earns more interest. Over time, this snowball effect can turn even small investments into substantial sums. For example, if you invest just a small amount regularly, your returns will grow not just from your contributions, but also from the interest those contributions generate. This is why starting early, even with little money, can make a big difference in the long run. Before you start investing, it's important to know what you're investing for. Are you saving for a house, retirement, or maybe a dream vacation? Setting clear financial goals helps you choose the right investment strategy and stay motivated. Write down your goals, both short-term and long-term, and keep them visible. This will guide your decisions and help you track your progress as you move forward on your investment journey. You don't need a huge budget to start investing. Begin by reviewing your monthly income and expenses. Identify areas where you can cut back, even if it's just a few dollars a week. Set aside a small, consistent amount for investing. Treat it like any other bill, something you pay every month, no matter what. Over time, these small contributions will add up and help you build a solid investment portfolio. Before you invest, make sure you have an emergency fund. This is money set aside for unexpected expenses, like medical bills or car repairs. A good rule of thumb is to have at least 3 to 6 months worth of living expenses saved. This safety net ensures you won't have to sell your investments in a crisis, allowing your money to keep growing undisturbed. Don't wait until you have a large sum to invest. Many platforms allow you to start with as little as $5 or $10. The key is to get started and build the habit. Even small amounts, invested regularly, can grow over time. Remember, it's consistency that matters most, not the size of your initial investment. There are many investment platforms designed for beginners. Look for ones with low minimums, low fees, and user-friendly interfaces. Some popular options include apps that let you invest spare change or buy fractional shares of stocks. Do your research and pick a platform that fits your needs and comfort level. It's important to know the different types of investments available. Stocks, bonds, mutual funds, and ETFs each have their own risks and rewards. Stocks offer ownership in companies and can grow quickly, but they're also more volatile. Bonds are generally safer but offer lower returns. Mutual funds and ETFs let you invest in many companies at once, spreading out your risk. Understanding these basics will help you make informed choices. Stocks represent ownership in a company. When you buy a stock, you own a small piece of that business. Stocks can increase in value if the company does well, but they can also lose value. They're a popular choice for long-term growth, but it's important to be prepared for ups and downs along the way. Bonds are essentially loans you give to companies or governments. In return, they pay you interest over time and return your money at the end of the term. Bonds are generally considered safer than stocks, but they usually offer lower returns. They're a good way to balance risk in your investment portfolio. A mutual fund pools money from many investors to buy a variety of stocks, bonds, or other assets. This gives you instant diversification, which can help reduce risk. Mutual funds are managed by professionals, making them a great option for beginners who want a hands-off approach. Exchange-traded funds, or ETFs, are similar to mutual funds but trade like stocks on an exchange. They offer diversification and often have lower fees. ETFs are a flexible and affordable way to invest in a broad range of assets, making them popular among new investors. Diversification means spreading your investments across different assets to reduce risk. Instead of putting all your money into one stock or bond, you invest in a mix. This way, if one investment performs poorly, others can help balance it out. Diversification is a key principle for building a stable and resilient portfolio. Fractional shares let you buy a piece of a stock, even if you can't afford a whole share. This is perfect for beginners with limited funds. Many investment platforms now offer fractional shares, making it easier than ever to invest in big companies with just a few dollars. Robo-advisors are automated platforms that build and manage your investment portfolio for you. You answer a few questions about your goals and risk tolerance, and the robo-advisor does the rest. This is a great option for beginners who want a hands-off approach and don't have time to research individual investments. Micro-investing apps allow you to invest spare change from everyday purchases. For example, if you buy a coffee for $2.50, the app rounds up to $3 and invests the extra $0.50. Over time, these small amounts can add up and help you build an investment portfolio without even noticing. Once you've chosen a platform, setting up your investment account is usually quick and easy. You'll need to provide some personal information, link your bank account, and answer a few questions about your goals. Most platforms guide you through the process step by step, so don't worry if you're new to this. Understanding your risk tolerance is crucial. Some people are comfortable with ups and downs, while others prefer stability. Your risk tolerance will help determine the right mix of investments for you. Be honest with yourself about how much risk you're willing to take and adjust your portfolio accordingly. Index funds are a great starting point for new investors. They track the performance of a market index, like the S&P 500, and offer broad diversification at a low cost. Index funds are known for their simplicity and reliability, making them a smart choice for those just getting started. Dollar cost averaging means investing a fixed amount of money at regular intervals, regardless of market conditions. This strategy helps you avoid trying to time the market and reduces the impact of short-term volatility. Over time, you buy more shares when prices are low and fewer when prices are high, which can lower your average cost. When your investments pay dividends, you can choose to reinvest them instead of taking the cash. This means your dividends buy more shares, which can accelerate your portfolio's growth over time. Many platforms offer automatic dividend reinvestment, making it easy to maximize your returns. Fees can eat into your investment returns over time. Look for platforms and funds with low fees. Even a small difference in fees can add up to thousands of dollars over the years. Always read the fine print and understand what you're paying for. Consistency is key when it comes to investing. Make investing a regular habit, just like saving or paying bills. Set up automatic transfers if possible, so you don't have to think about it. Over time, your steady contributions will help your investments grow. Keep an eye on your investments, but don't obsess over daily changes. Check your portfolio every few months to make sure you're on track with your goals. Adjust your contributions or investment choices if needed, but avoid making emotional decisions based on short-term market swings. New investors often make mistakes like chasing hot stocks, trying to time the market, or investing money they can't afford to lose. Stay disciplined, stick to your plan, and remember that investing is a long-term journey. Learning from others' mistakes can save you time, money, and stress. Investing is not a get-rich-quick scheme. It takes time for your money to grow. Be patient and trust the process. The most successful investors are those who stay invested for the long haul, allowing compound interest and market growth to work in their favor. You don't need to know everything to get started. Begin with the basics and keep learning as you go. There are plenty of free resources online, including articles, videos, and podcasts. The more you learn, the more confident you'll become in making investment decisions. It's easy to get caught up in the excitement or fear of the market. Emotional investing can lead to poor decisions, like selling during a downturn or buying at a peak. Stick to your plan and remember your long-term goals, even when the market gets rocky. Consider using tax advantage accounts like IRAs or 401ks if they're available to you. These accounts offer tax benefits that can help your investments grow faster. Contributions may be tax deductible, and your money can grow tax-free or tax-deferred, depending on the account type. Even if retirement seems far away, starting early gives your money more time to grow. Small contributions to a retirement account can make a big difference over decades. Take advantage of employer matching if it's offered. It's essentially free money for your future. As your financial situation changes, review your investment plan and make adjustments as needed. Maybe you can increase your contributions, or perhaps your goals have shifted. Regular reviews ensure your investments stay aligned with your life and priorities. Everyone's financial journey is different. Don't compare your progress to others. Focus on your own goals and celebrate your milestones. No matter how small, investing is a personal journey, and every step forward counts. The world of investing is always changing. Stay informed by reading financial news, following market trends, and learning about new investment opportunities. Being informed helps you make better decisions and adapt to changes in the market. If you're unsure about where to start or how to invest, don't hesitate to ask for help. Financial advisors, online communities, and trusted friends can offer guidance. Remember, everyone starts somewhere, and seeking advice is a smart move. Take time to celebrate your progress, no matter how small. Each contribution, each milestone, and each lesson learned is a step toward financial freedom. Recognizing your achievements keeps you motivated and committed to your investment journey. Don't overcomplicate your investments. Simple strategies, like regular contributions to index funds, often work best. Avoid chasing complex products or trying to outsmart the market. Simplicity leads to better results and less stress. When investing online, always prioritize security. Use strong passwords, enable two-factor authentication, and only use reputable platforms. Protecting your personal and financial information is just as important as choosing the right investments. Regularly review your investment statements to ensure everything is accurate. Check for unexpected fees, unauthorized transactions, or errors. Staying vigilant helps you catch problems early and keeps your investments on track. Markets go up and down, sometimes for reasons that are hard to predict. Don't panic when you see your investments drop in value. Remember, downturns are a normal part of investing, and markets have historically recovered over time. Be wary of anyone promising fast, guaranteed returns. Real investing takes time and patience. If something sounds too good to be true, it probably is. Stick to proven strategies and avoid risky schemes that could cost you your hard-earned money. Maintain good records of your investments, contributions, and transactions. This makes tax time easier and helps you track your progress. Many platforms provide downloadable statements, but it's smart to keep your own backup as well. Every step you take, no matter how small, is progress. Celebrate your first investment, your first dividend, or reaching a savings milestone. These small wins keep you motivated and remind you that you're moving in the right direction. Take time to reflect on your investment journey. What have you learned? What would you do differently? Regular reflection helps you grow as an investor and make better decisions in the future. Remember, every experience is valuable. You don't need a lot of money to start investing. With the right mindset, a clear plan, and consistent effort, anyone can begin building wealth. Start small, stay patient, and keep learning. The most important step is simply to get started. Your future self will thank you for taking action today